Central bank also is forecasting better unemployment rate in 2026 than they originally thought, at 4.4%. At 4.4% unemployment in 2026, if this forecast turns out to be true, that would be near historically low levels. And so that would indicate a relatively strong economy, even though the 4.4% unemployment rate would be higher than where it was, let's say, 2 years ago. Unemployment is definitely trending higher, but it's still at relatively low levels. And to give you a better perspective on where the unemployment rate is today compared to historical levels, I've shared with you this chart here from FRED, which is the Federal Reserve website for unemployment, fred.stlouis.gov, where you can get economic indicators like this one I'm sharing with you here. The unemployment rate, looking back historically, at the current unemployment rate of 4.6% as of November of 2025, and you look back going all the way to 1950, this is near the lower end of where the unemployment rate has been. In fact, even though unemployment has been trending higher, as I mentioned, since 2023, in April, it reached a low of 3.4%, and since then it's been steadily increasing. Now it's up to 4.6%. It's still well below historic levels. And so if the unemployment rate remains around the mid 4% range, it would still indicate a strong economy. And I think one more point of emphasis is the trend line of increasing unemployment is at the slowest rate going all the way back to 1950. So you've seen increases on unemployment before, and those increases have come at a faster pace than what we're seeing today. And I'll talk a little bit more about why this is the case. Employers are hesitant about firing individuals. Remember, when the economy reopened from pandemic lockdowns, employers had such a difficult time finding folks, hiring folks, and they had to spend a lot of resources to get people onboarded. And so they don't want to fire people after spending so much resources to get them on board. And so they're hesitant to do that. Instead, they're managing their cost differently. They're decreasing cost by not replacing individuals that quit or retire or change jobs. They're reducing the amount of hours they offer workers. They're cutting overtime. They're cutting shifts. They're finding different ways to slow labor hours or labor spending other than firing people.